Good morning and welcome this morning to Trading Futures, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. Joined out there in the chat by my good friend Connie Hill. Glad to have her with me, helping to answer those questions along the way. She's a 20-plus year veteran in the financial markets. She's out there to help keep the conversation going. Welcome to all of you, whether you're here in the live version or the recorded version. Either way, be a part of the conversation. Chat some questions in. If you are here live, leave us a comment in the description section. If you are in the recorded version, and boy, I tell you what, what a time to be alive and trading futures, yeah? That said, we're not advocating any one particular type of account or anything else, but let's talk a little bit about those housekeeping items as we get started, and we'll talk about the volatility that's going on in today's trading. Remember that everything we talk about is simply for illustrative and educational purposes only, not a recommendation of any particular security or strategy or account type or any symbol or anything else. So when I say what a time to be alive and trading futures, that is in the sense that there is a lot to talk about, not necessarily in the sense that you should be trading futures. That being said, if you are going to trade futures and futures options, remember that involves substantial risk. Those are highly leveraged products. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of those products. Make sure that you understand and read the risk disclosure statement for futures and options before considering any of those transactions in futures products. Also, remember that futures requires a margin account, and that futures margin, also known as a performance bond, is the amount of money that you're required to deposit in the futures account to establish and maintain a futures position. So understand that scenario. Also, remember that as we talk about some of these ideas, that we're going to use technical analysis. Technical analysis is only one way to evaluate the market. Probability analysis, fundamental analysis as well. All of those are theoretical. None of those are guarantees as to what's going to happen in the market in the future. We may talk about virtual currency derivatives today. Recognize that virtual currency derivatives have special and unique risks. Virtual currencies are digital representations of value that function as a medium of exchange, among other things. They do not have legal tender status as of yet. And so there are risks associated with those products. Make sure that you read the NFA Investor Advisory and the CFTC Consumer Advisory prior to trading any of those products. Also, as we get into this discussion, and this is a highly interesting and very well discussed debate, and it's not really a debate, but it is something that we need to pay attention to. That stop orders and by extent market orders in a futures product behave differently than a market order or a stop order that generates a market order in an equity product or an option product. The futures exchanges, due to their rules in certain conditions at the time of sending that market order to the exchange, will substitute that order for what they sometimes refer to as a market with protection, but it becomes essentially an exchange designated limit order within a particular protection range or protection band. That is to protect investors in the exchanges against quick moving markets where that order could fill at a substantially different price. So there is the possibility that a trader may submit via stop order or a designated market order to the exchange. An order that gets rejected, doesn't get filled because it's outside of that protective range, or doesn't get filled at a particular price. So just be aware of that fact that stop orders, anything that generates a market order, creates a scenario for the exchange where that order gets worked as a market with protection order, or what's sometimes referred to, again, as an exchange designated limit order. Just so that we're aware of that, getting that out on the table and discussed, because it is a topic of discussion. All right, let's pop over here to the Thinkorswim desktop software platform and see what's going on this morning. Now, what I'm going to have to do is pop over to my Paper Money platform this morning, and I wanted to take a look at really quickly here in this discussion. And by the way, when we're talking about using paper money, we're using the Thinkorswim desktop software platform. That Thinkorswim desktop software platform is specifically the paper money version. Great learning environment, not a guarantee of what's going to happen out there in the market. Additionally, paper money behaves a little bit differently than a live trading account. All right, taking a look at the ES here this morning in the, in the futures market, kind of rolling down from that 200 period moving average, so staying slightly below that 200 period moving average, and that has really been kind of the near term resistance on these equity futures, especially the ES, kind of bound up by that, waiting for some data. We've got data points this week. We've got Fed speakers. We've got PPI. We've got other data. And we have the start of earnings season, which really kind of starts to crank here on Wednesday into Thursdays. We get the banks reporting earnings. And there's kind of this waiting for the next shoe to fall, metaphorically and perhaps literally as well, when it comes to the geopolitical risk that is going on out there in the market. So there is a little bit of wait and see. There's some bullishness when it comes to the RSI. We see the RSI kind of ticking higher here. We also see that the ES kind of running up against that resistance level. NASDAQ, kind of the same thing. We see a fairly bullish RSI coming up off of a reversal down in the lower reversal zone. We haven't seen a touch below that 30% level on the RSI since last April, Liberation Day, and we saw a strong reversal from there. You know, this could be potentially, if there is a resolution to some of the geopolitical risk that's out there, that could be a scenario where we could see a strong move to the upside. There is some building pressure there, right? Underneath the resistance level, RSI giving us indication that prices are closing closer to the highs on those candles. And we're seeing the Russell 2000 kind of underneath the 50 in the same kind of scenario. Stronger RSI, kind of a bullish divergence in the RSI and the Russell 2000 and the small caps starting to move a little bit higher here. But let's take a look at a couple of other things that might be kind of mitigating this, if we will. So I'm going to pop into my single grid really quick. We're going to pop over here to VIX. We're going to take a look at what's going on in the VIX. And I'm going to hide a couple of these indicators down here in the bottom because they're not really necessarily relevant when it comes to the VIX in terms of momentum indicators. But we can see the VIX rising just a little bit today. So staying elevated, kind of establishing that baseline well above where that baseline had been over the course of the last year, really since the big spike last April in terms of the Liberation Day issues, the tariff issues. Now here we are, we're kind of sitting at a baseline right around the 24 handle on the VIX. Saw a little bit of a bounce of that yesterday. Starting to see that VIX a little bit elevated here this morning. And if we take a look at the VIX futures /VX, in this case, we can see that the VIX futures themselves a little bit more elevated than the VIX is resolving itself. And remember, the VIX is the average, that 30-period average of SPX index options. And because of that, it's not a tradable instrument. The VIX futures are. Options on VIX are tradable, but the VIX futures are also tradable. And so this is where some of that speculative pressure may come into place, where we're seeing the likelihood, potentially, given what the VIX futures are doing, of a pop to the upside in VIX. Now, the nature of VIX is this, that it moves fairly quickly on emergent events and news, and then tends to kind of settle itself out pretty quickly. It tends to be somewhat of a panic gauge, if you will, from that standpoint. So we're not seeing a lot of panic, but we are seeing still some upward build in VIX futures /VX futures here to the upside, but those could quickly resolve to the downside, as we have seen before in terms of trading this particular product. Now, I want to pop over here really quick, because this is, I think, probably what's on everybody's mind, especially if you have been to the gas pump at any point in the last little bit. This is crude oil. and we can see some pretty big. So this was over the weekend, the big move to the upside in the VIX or in the oil futures. We see a little bit of a bull flag pullback, which was simply kind of a settling back of this big buying on that 4-2 contract move. We start to see that move to the upside, seeing a little bit of a pullback. Now we're starting to see VIX futures up, or excuse me, let's settle back where we are. Crude oil futures in the big contract up almost 3% once again today. Now, we kind of pride ourselves on not being political in this discussion. So I'm not going to be political, but I'm just going to say this. There is political confusion, I think, if you will, on the part of the market from that standpoint, in terms of what might happen. Will we get a deadline? Will we not get a deadline? And I think that's adding to this upward move and this upward speculation. That being said, I would argue perhaps that as we were to look at something like the RSI as a momentum gauge, we're kind of seeing momentum falling off as upward movement is increasing. So if we're using RSI kind of as its measurement technique of measuring momentum, it may be increasing, but we've got a bit of a bearish divergence still in upward momentum, which suggests that there are traders on the side of thinking that this may resolve itself fairly quickly, and we may see a quick reversal to the downside in these crude oil contracts. And that is very possible if there is if it's possible to have a precise and absolute and discrete unique resolution to this. And I don't know if that is possible. But if that is the case, then crude oil contracts could potentially, from a technical standpoint, and this isn't me speculating, this is simply technical analysis, could reverse fairly quickly. And they have done that before in geopolitical stress points. So there is, I think, perhaps some speculative downward pressure here. If it were all objectively bullish on crude, I think you'd see the RSI a little bit higher in this particular case from a technical perspective. Now, that being said, some of the other products within the crude oil and energy complex /HO, seeing from a technical basis, not new highs, so still seeing some build. So again, this is kind of that maybe an indication of some demand destruction. The fact that these prices have gone so high so fast. You've got airlines, you've got shipping companies, you've got trucking companies that are backing down on capacity simply because of the crude oil prices, and then that's translating into heating oil, diesel fuel prices, those types of things. If you take a look at /RB, which is the gasoline contract, you're starting to see kind of the same thing, and you're seeing a much wider bearish divergence in terms of price versus the RSI. So let's kind of draw that line here. You got the RSI making lower highs. You've got price making roughly equal highs here on the gasoline contract. So here we are coming out of the Easter weekend, which is a holiday weekend for many people, and driving pressures typically start to increase about this time, right? Spring break, those types of things, we start to see driving pressure and gasoline pressure increasing. Now starting to see maybe that bearish divergence leading this to some sideways trend. To me, from a technical basis, that suggests, again, demand destruction, that these prices are so high on a rack basis, and then translating that into the pump prices, that people are just stopping and not really driving as much. They're being much more discretionary in terms of driving scenarios here. But okay, that remains to bear itself out. Carol says the VIX is at 2583 and rising fast. So let's do a couple of things. What I want to do also before we leave the energy complex here is I wanted to look at this OVX. So we've got the VIX of the equity markets. Actually, I've got to do this OVX : CGI so that we get the, whoops, let's see if we can get it here. OVX colon CGI right there. That's the one that we want. Okay. This is essentially the VIX, the volatility index for crude oil. And this is kind of the same methodology, although this does not use the futures contract or the index itself. This, in fact, does use the crude oil ETF and options on that crude oil ETF. Now, this isn't an ETF class. We're not talking about ETFs. Just a really quick reminder, if you're going to trade ETFs or exchange traded products like that, make sure that you read the prospectus, you understand the characteristics, risks, charges, and expenses for those products. But this is a measure of volatility in crude. And we're seeing that volatility in crude beyond implied volatility. This is kind of that overall perspective. We're starting to see that rise a little bit here as well. It has fallen significantly, but it is still remaining elevated. So this OVX is to crude as VIX is to SPX, if that makes sense for those of you who are SAT test aficionados. That's a test question that oftentimes gets asked. So here's the VIX. We're seeing the VIX elevating a little bit. We're now up at the 26 handle. As this market gets up and running, that's kind of giving us that sense of what's going on. So what we're going to do is we're going to pop over here to our let's pop over here to our futures movers grid, and we'll put this in its side-by-side mode. So we'll restore those cells. And I first want to take a look at /MCL, and we'll see what's going on here, because we have, again, that little bit of a move to the upside. So this is the crude oil contract. This is the micro crude oil contract. We're kind of in that short term. Left-hand side is a 1-year daily. Right-hand side is a today's trading in 5-minute increments here. We're starting to see, again, that momentum shift a little bit to the downside. So we've got a bit of bearishness potential just with that divergence going on. So you've got roughly equal highs. You've got lower highs in the MACD, suggesting that maybe there is a bit of bearish potential here. So from that bearish potential, there is the possibility that a trader could be looking to speculate again to the downside. So what we're going to do is we're going to look at putting a potential trade on here as an example. If this traverses back down to the downside, if there's some kind of news that suggests that maybe there is a bit of a resolution. We were starting to see that shift a little bit with, again, that goes back to the question here. So we're starting to see this latest candle giving off a bit of a shooting star perspective. So I'm going to zoom in over here on the right-hand side just a little bit, and we'll kind of look at how we might put this trade together. So I'm going to draw a line here at this resistance level. And I'm going to draw a line down here at this previous support down around 111 or so. And here's how I'm going to label this trade so that we can kind of see what we're looking for here. In this case, our entry is going to be right here. Our stop in this case is going to be right there. And our target is going to be a move down to that next level of support. So looking at a short-term trade. Now, really quickly, let's put this trade on, and then we'll come over and we'll talk about the characteristics of this trade. So what we're going to do is we're going to look at creating a sell stop. But again, remember, a sell stop order is going to get worked as an exchange designated limit order. I'm going to right click at that level, and I'm going to do this. I'm going to do a sell custom with OCO bracket in this particular case. So our entry, and let me just kind of make these a little bit wider so that we can see it and see what those numbers are. So our entry is going to be on a move below this 114, we'll call it 114.80. So I'm going to make that 114.80 a move below that level. And that's going to be on a sell stop. Now, if we put this in as a limit order right now, that's just going to fill because we would be selling significantly higher than that. We don't want to sell where it is right now. It'd be great if we could, but that doesn't give us the confidence that the trade's going to go in the direction that we expect it to go. So what we're going to be looking for is a move below that 114.80. So now this needs to change from a limit order to a stop. Now we could make it a stop limit, and then we're going to be able to designate that range. I'm going to use this as a stop, which is going to create a market order, which is then going to get worked as an exchange designated limit order within that protection range. So recognizing that this may not get filled at the price that I expect it to get filled, it may get rejected if this market starts to move significantly and quickly to the downside. But I'm going to leave that as a day order because who knows what the rest of the day is going to bring, right? In terms of this trading session. So now my stop on the other side is going to be limit buy to buy this back if it goes, in fact, up above this 116.25 level. So I'm going to make that 116.25. So we're going to make that limit 116.25. And we're going to make that one good till canceled. Now, obviously, these orders aren't going to be in place until the initial order triggers and fills. Then the limit buy is going to be in place. And then the buy stop is going to be in place, which says don't buy it until we get down to that 111.25 mark. So we'll make this buy stop down at the bottom, 111.25. That's going to be our target. We're shooting for that price to move to the downside. In this case, we're going to make that good till canceled. Remember, this is a bearish trade. And this bearish idea is that if oil reverses and it does it quickly, we may capture this quick move, or maybe not quick move, from this 115 or basically the 114.80 mark down to 111. And that's how we're going to try to capture that downside move. So we're going to go ahead and look at confirm and send. Now that we've got that order in place, we want to make sure that this is what we want it to do. Looking at those transaction costs, making sure that we understand this is our buying power effect, or in other words, our initial margin into this trade. So remember, when we're trading a futures contract, we're not necessarily buying or selling that contract. We are initiating a short or a long position in that contract. In order to initiate that short or long position in the contract, what we have to do is pledge that or put up that initial margin that then becomes a maintenance margin as that starts to as that trade becomes initiated and then starts to move. So I'm going to go ahead and I'm going to click on send here, and we're going to fire this order off. I'm going to put this in our futures group just so that we can keep track of it. So Momo asks a question: does volume not matter? It's about 200,000 volume. So here's the thing about especially crude oil contracts right now. Volume in this particular case, in terms of the contract itself, we can look at volume and open interest. These are very liquid contracts, and so we're not necessarily worried too much about that volume. So Barbara asked the question, why did I choose my stop? So why did we put the stop back up here? Because that stop in this particular case would be confirmation that price is in fact moving in an upward direction. Let me grab my magic marker just to kind of line this trade out so that you can see my logic behind this trade. The expectation is that if price breaks this level to the downside, that it's going to move all the way down here to this target, that next level of support. If it doesn't, if we get kicked into the trade, right? If we get kicked into this trade and now that price moves up here, and instead of going down, goes up, this is where I want to be out of the trade. So remember, we're going short this contract, right? So the stop is a buy order, okay? And we're going to be buying this back, and we're going to buy it back at a particular limit price, right? So You know what I did? Somebody who caught it. Some of you caught it. Okay, cool. This is this is why it helps definitely to read through the order, right? Read the freaking order. So why not stop it out up here? You could certainly stop it if it were to go, but I want to give it a little bit of volatility. But you know what? I placed this order wrong. So let's do this. Let's go over to the monitor tab and let's take a look at this order, because look what I've got here. I've got a limit order to buy this back, and then I've got a sell stop order, or excuse me, a buy stop order to buy this back. But I reversed those two. So you know what I'm going to do? I'm going to cancel this whole thing. We're just going to cancel this order. And I'm going to put this order back in place, and we're going to talk through it once again. So let's talk through this order one more time. So we're going to go back to our chart. I'm going to right click right down here. And again, I could put my stop. I could take the trade off. Yes, RTFO. Thank you, Carol. Absolutely. I ignored my own advice at my own peril in this particular case. But here's the thing. I could put my stop just above this level and get out at a tighter stop. But this is, again, remember, fairly volatile product. So I want to give it a little bit of room to wiggle before I get out of the trade. So let's come back over here to this level, 114.80, right click, sell custom with OCO bracket. Let's make sure that we're walking through the methodology here. Okay. So 114.80 is going to be my entry. I want to get into that trade on a sell stop. So if price moves to the downside, so we're going to make that a sell stop. To stop, wait, don't do anything until price gets to 114.80, then go short the contract. Now, to get out of the trade, once we're in the short position, I've got to buy it back. So I want to buy it back if it goes down. So I need to change this order to my target, the first one, 111.13, or excuse me, 111.25 is what we had, 111.25, which says, okay, don't do anything, buy it back, buy that back when the price of that contract gets to 111.25 or less. Because when you're buying something, or better is less. Limit always says or better, this price or better. So I'm going to make that a good till canceled. Now I'm going to make this a buy stop on the second one. I had those exactly reversed. So thank you guys for catching that. I kind of knew something was wrong in the back of my head. So I'm going to say, look, buy it back if it goes to 116.25, but do that on a buy stop. So 116.25, which is stop, wait, don't do anything until the price of the contract gets to 116.25, then buy that contract back and close the trade down. So you guys had it. You guys caught it. Yeah, you could. I mean, 1.5. Sure, go ahead, Barb. I think that is, certainly something. I think this is a clear illustration of how there are differences of opinion, right? So I'm going to click on confirm and send. I'm say, look, okay, sell one contract, then we're going to buy it back if it goes to 111.25, or we're going to buy it back if it goes to 116.25. Those are two exit points. Still, here's our initial margin into the trade. We're going to go to the futures group here, and we're going to put it in that futures group, and we're going to go ahead and send that order off. And we're starting to get some upward movement here. This order may not fill in this particular case. So, in fact, it's starting to move higher. Now, that being said, there's no guarantee that it's going to continue to move higher. There's no guarantee that it's going to move to the downside. We've put in an order that is potentially able to take advantage of downside movement. Let's go over to the left-hand side of this chart and kind of go through the labels here. So I've got this futures label. By the way, for those of you that are brand new to this webcast, I'm going to go ahead and I'm going to share with you this grid out in the chart and into the chat so that so that you've got that. But remember, anytime we share anything, that's for illustrative and educational purposes only. It is not guaranteed as to time or accuracy. But that grid that I just shared with you has this futures label scripting on it, which has the tick size, the minimum increment that this moves, which is the significant digit and the minimum amount that that significant digit moves. So the tick size is 0.01, which means that this this digit that I'm hovering over, that I'm putting my cursor on right there, moves in 0.01 increments, and that is the number that we watch for that tick size. The tick value, every time that ticks, is $1. That means that the point value, when this moves from 116 to 117, or from 116 to 115, that's $100 move. And then the total notional value is that $100 times this amount. That gives you the size of the contract. One way to think about that is this point value is roughly the equivalent, if you will. It's not an exact comparison, but it is roughly the equivalent of the delta of this futures contract. So OBT asks a question. The slides from the Atlanta workshop were attached to the email that you received, the confirmation email, as a resource guide, and that's downloadable. So you already have them, but that's a great question to ask. I'll talk a little bit about that as we get into this discussion, as we get into some additional resources. All right, so let's see what else is moving here this morning. That's /MCL, that's crude oil. Let's take a look at the gold market as well. I'm going to put this back on our two-sided view just by clicking on Restore Cells. And we're going to come back over here and we're going to take a look at /MGC. This is the micro gold futures contract. And gold seems to be slipping a little bit here, not doing it with a lot of momentum and kind of running into this consolidation zone right here, but some downward push in terms of gold /MHG in the copper space. And we're starting to see copper moving to the downside here as some challenges as we start to see rates changing. Perhaps we're starting to see the economics of the chip space changing, which is a copper demand industry. So starting to see some downward momentum here in that copper contract. So that would suggest then, if we look over here on the left-hand side, starting to see maybe a break of this diagonal trend line. So now that we've drawn that diagonal trend line in the longer term chart, we can kind of see where that is over here in this shorter term chart. So I'm going to shift to the shorter term chart. We're going to maximize the sell, and I'm just going to kind of squish this down a little bit here. So that might be our line in the sand that says, if this goes below that level, I want to get into the trade. So we're going to look at trading this perhaps to that downside in this micro copper futures contract in this particular case. So again, going short. So if we go right here to the left-hand side, here's that tick size again. That means our significant digit is right here. When that ticks, that's $1.25. That means that the point value, when this moves from 5 to 4 or 5 to 6, that's $2,500. $2,500 times 5.5515 gives us our notional value. We click on the drop down and we look at our futures subgroup. And that means that our initial margin into this position is going to be $1,320, right? That's how you can find what that initial margin, or in other words, buying power impact. That's the way that it's expressed in the Thinkorswim platform. In most cases, the margin, the initial margin is going to be about $1,320. So let's go to the right-hand side. And we're going to look for that break to the downside. And we're going to look at maybe stopping this if this goes up to this level, where that resistance is. Let's draw a line there so that we can define this at 5.5989. We'll put a resistance there. And we're going to look at an entry below this level. So I'm actually going to give this a little bit of flexibility down to 5.54. Right click, and I'm going to do a sell custom with stop. So I'm not going to look at necessarily setting a trigger to get out of this trade because I don't have a really good definition of that yet. But I do have an area where I might stop this order out. So I'm going to get in this trade on a sell stop. So I'm going to change this to a sell stop, and we're going to do that below 5.54. And we're going to stop this, meaning we're going to buy this back if it goes up to 5.5. Let's call it 5.6. Let's call it 5.6. 5.6. And that's going to be as a buy stop order, not a limit. Because if we were to put that as a limit, that would buy it at the cheaper price. We don't want to buy it at the cheaper price. We want to buy it back when it has gone up, if it's going against us. So this is more of a trend trade, looking to trade this to the downside if we get a clear break of this kind of line of demarcation, that level of support here. So we're going to click on confirm and send, read through this order, make sure there's our initial margin. So sell if we get to 5.54 or below, buy it back if it goes back up to 5.60 or above. And we're going to put this in our futures group, click on send, and fire that order off. At least now it's out there and waiting. So these two orders are out there and waiting. So let's do this real quick. While we're right here, let's go to /. This is on the shorter term view. We'll put this in put this grid in our side-by-side mode, which is clicking on restore cells so that we can see side by side. Now we're going to come back over here and let's take a look at /MES and see what's going on. So once again, the equities contract kind of doing the same thing that copper is doing. It's broken that level of support here, broken it pretty significantly. Now starting to turn around. Now here's the thing. Much like that crude oil contract, if crude oil is going down, guess what's likely happening here? And that is potentially that ES is going to be moving up to the upside. Again, a little bit of a bullish divergence when it comes to momentum. So we could put a trade on if it comes back up above that level, but I want to see if there's something else that's maybe a little clearer in terms of this entry. So one of the things that we can do when we start to see this is you can come over here to the futures contracts and you can kind of just scroll through this list. So one of the things that we might be seeing if our market is moving to the downside is we may look at something like Japanese yen to see if there's some movement there. We may look at /DX dollar futures, which we've looked at before, /DXY. Let's see if we can do that. We can't in this case because this account, because I had to use my paper money account, doesn't have access to those ICE symbols, which means that I can't also trade things like cocoa futures or other products like that trade on the ICE exchange. And we've talked a little bit about that before. But let's see what Euro futures are doing. Euro seems to be moving to the upside. These are the Euro futures based on the US dollar Euro pair, and starting to see maybe a little bit of upward movement here. Let's see what else might be moving in this particular case. Let's see what Bitcoin is doing in this particular case. And Bitcoin seems to be moving to the downside, much like what the ES futures are doing. Let's see if there are some other moves that might be happening here in terms of the market. Let's take a look at the ags for just a second. I want to pop in here to corn futures and see what corn futures are doing. Corn futures, which this is a fairly illiquid contract, /ZC is the bigger contract, and you can see the corn futures or agriculture futures are on the rise a little bit with a little bit of a bearish divergence going on. Let's take a look elsewhere and see what else we've got going on here this morning in terms of movement. Let's take a look at natural gas, because that's another one of those areas that has obviously some volatility in this space. So natural gas seems to be moving. This is the / MNG. So this is the natural gas contract, and starting to see maybe that little bit of a bull flag move here, but it's doing it with lower momentum. So this volatility is increasing, but it's not really doing it with a lot of conviction one way or the other. And this is a fairly volatile contract. So if we were to pop this back and maximize our sell here, this is one of those bull flag type of patterns that a trader could use, and we could just simply project distance here. I know we don't have a lot of time remaining, but we could put a trade on something like this and looking at a projected move based on that bull flag pattern, maybe out here to that 2.93 level or so in terms of that breakout. So that's a possibility as well. Yeah, having access to the ICE exchange requires signing up for it, signing the agreements, and there is a monthly fee for that as well. Thanks, Connie, for doing that. So that's a possibility here with / MNG in terms of putting that on. So let me do this. Let's pop back over here real quick. I want to show you some resources really quick. So if you are new to trading futures, one of the places that you can go is really easy to remember. Schwab.com / futures. And you can walk through this page to talk a little bit about what a futures contract is, futures margin, how to trade futures. You can see some of those futures markets that we've talked about today, why trade futures and why trade futures at Schwab. How do you open up a futures trading account? Some of those characteristics of futures accounts that you need to be aware of and pay attention to. If you want to learn a little bit more about, for instance, technical analysis or the futures market or something else here, come over here to the youtube.com @TraderTalks webcast page. Make sure that you click on subscribe, by the way, when you do that. And you can type in here futures. And you're going to get the futures playlist. You're going to see all the webcasts that we teach on an ongoing basis that touch on and talk about futures. So that's, again, a helpful resource. And then I'm going to show you right here. This is, again, easy to write down, easy to remember, schwab.com / coaching. This is where you're going to find the forward calendar for our webcasts. But for those of you who are asking about in-person events, click right here where it says in-person events. Now, I'm going to be leaving for Dallas here day after tomorrow. We're doing our advanced option strategies workshop. 1/4 of that advanced option strategies workshop is going to be introduction to futures. So if you're going to be in Dallas, join us for that. We're going to be at the Gaylord Texan in Dallas. This is at no cost to you. Then we're going to be in Boston next week. Holy cow, that's coming up fast. We're going to be doing our technical analysis and option strategies, much like we did in Atlanta. If you click right here where it says learn more, and you click right down here where it says view agenda, now you're going to see that download guide right there, OBS, that's where you're going to find those slides from the workshop that we use. That's the resource guide for each one of those days. So we got you there. My thanks to Connie Hill for helping out. Keep an eye on those volatility indexes, both the VIX and the OVX, for not only equity market volatility, but also energy complex and oil volatility as well. My thanks to our great reviewers and our great production staff. I'm going to be back later today, this morning, teaching getting started with options. So we'll see you then. Take care, everybody. Bye-bye.